Hey everyone, and welcome to today's Explainer. We are jumping right into one of the most common, yet kind of maddening, everyday mysteries we all deal with. Have you ever walked into a grocery store with the exact same amount of cash you normally carry, only to realize it buys you way fewer things than it used to? You check your wallet, the money looks exactly the same, but it feels completely different when you actually hit the checkout counter. Well, that little disappearing act is exactly what we're decoding today.
Okay, let's dive into this by looking at a scenario we all know a little too well. Imagine holding a crisp $100 bill or a 100-pound note. Now, that piece of paper has a fixed number printed right on it. But as time goes on, that same $100 pays for a constantly shrinking basket of groceries. The number printed on your money, it stays exactly the same. But its actual power, its ability to get you the things you actually need, is just vanishing right in front of you.
Section 1. What is inflation?
So let's nail down the core concept here. Basically, inflation is a sustained increase in the overall level of prices across an economy. Now, I want to do a quick bit of myth-busting right here because this is super important. Inflation means the general price level is rising. It absolutely does not mean that every single individual price tag in the store goes up at the exact same time or even at the same rate. Honestly, some things might even get cheaper. But on average, looking across the whole board, from milk and bread to your bus ticket, the overall tide of prices is rising.
And this brilliantly illustrates how that rising tide actively shrinks your purchasing power. Imagine a shopping basket filled to the absolute brim for $100. We'll call that basket A. Fast forward after prices have risen throughout the economy, and that exact same $100 gets you basket B, which is noticeably smaller and holding way fewer goods. You have the exact same money, but a whole lot less buying power.
Section 2. Why do prices rise?
Spoiler alert, there's no single villain behind this. Instead, economists generally point to three major drivers of inflation. We've got demand, costs, and supply shocks. These are the big economic forces constantly pulling the strings behind the scenes of our daily lives. So let's break them down one by one.
First up is demand. Picture a massive crowd of shoppers all trying to get their hands on a very limited product, like tickets to a sold-out concert or that one holiday toy everyone literally has to have. When demand shoots up, but the available supply is limited, buyers are essentially competing against each other for those goods. That intense competition naturally puts upward pressure on prices. The market responds to all those eager buyers by just yanking the price tag higher.
Now, the second major cause works from the completely opposite direction: costs. Think about the businesses that are actually making the products. If the basic ingredients of their business become more expensive, say energy bills skyrocket, transportation gets pricier, or raw materials cost a fortune, their overall production costs increase. And businesses generally aren't just going to absorb those massive hits, right? They push those increased costs right down to the consumer. So because the price of making the product goes up, the price of buying the product goes up too.
And finally, we have the third major driver: supply shocks. This happens when there is a sudden, unexpected disruption in the system. Imagine a huge factory shutting down, or massive delays in global shipping. The supply chain just breaks. This drastically reduces the available supply of goods that actually make it to store shelves. Even if demand stays exactly the same, meaning people aren't rushing out to buy any more than usual, that sudden drop in supply forces prices to spike. There's just less stuff to go around.
Section 3. Inflation and your money.
Let's look at a fictional savings account holding, say, $5,000. It's just sitting there, maybe earning a tiny bit of interest. But here is the silent threat of inflation. If your money grows more slowly than prices rise in the wider economy, the actual purchasing power of those savings is just quietly declining over time. The number on your bank statement might proudly say $5,000 or even $5,100, but if everyday goods suddenly cost 10% more, that money simply cannot buy what it could a year ago.
So the crucial point is that this directly impacts your standard of living. You see, your standard of living isn't just about whether your salary goes up. What truly matters is how that wage growth compares directly to the rising costs of your monthly expenses. If you get a raise, but prices go up even faster, your actual ability to afford your life goes down. It's literally a constant race between your income and inflation. Interestingly enough, inflation doesn't treat everyone equally, especially when we start talking about debt. It impacts borrowers and savers very differently. The effect really depends on specific factors, like what type of borrowing you have, whether your interest rates are fixed or variable, and the exact terms of your contract. Under certain economic conditions, inflation can actually ease the real burden of fixed debt for borrowers, while at the same time completely squeezing the value of cash for savers.
It's a really complex balancing act, dictated by the terms of the money you hold or the money you owe.
Section 4. The Central Bank Response. Enter the heavy hitters, central banks. We're talking about institutions like the Federal Reserve in the US or the Bank of England in the UK. These entities use what's known as monetary policy to influence economic conditions. Their primary goal is to maintain economic stability, and a huge part of that job involves stepping in to try and manage inflation when prices start rising way too fast.
So the main tool they use to do this is the interest rate dial. Here's how that mechanical chain reaction actually works. When central banks want to cool down inflation, they start by increasing interest rates. This immediately makes borrowing money more expensive for everyone, from a family trying to buy a house to a massive company trying to expand. Because money is suddenly expensive, spending naturally slows down. And as spending drops, overall demand in the economy weakens. As we learned just a minute ago, less demand relieves that upward pressure on prices. But, and this is vital, monetary policy works with a massive time lag, and outcomes are never guaranteed. It's kind of like turning the steering wheel on a giant cargo ship. You can spin the wheel all you want, but it takes time for the ship to actually turn.
While we're looking at the broader economy, let's bust another really common myth. People confuse these two terms all the time, but inflation and a recession are fundamentally different things. Inflation means general price levels are rising. A recession is a significant decline in overall economic activity. You can absolutely have an economy that is experiencing rising prices, inflation, without actually being in a recession. They're totally distinct conditions that can happen separately or together as the economy shifts.
Let's move to and see how this builds into our final understanding. Section 5, the big picture takeaways. At the end of the day, inflation is highly, intimately personal. Depending on exactly what you buy, your specific mix of groceries, your housing setup, how far you have to commute, and your unique household budget, your experience with rising prices can differ wildly from your neighbors. If the price of gas spikes but you work from home, your personal inflation rate is vastly different from a delivery driver's. We all feel the changing tide for sure, but our boats are all built a little differently.
So, to lock in everything we've covered today, here are our 5 key takeaways distilled right from our sources. 1. Inflation means the overall price level across the economy is going up. 2. This rise actively drops your money's purchasing power. 3. It's driven by multiple causes like demand, cost, and supply shocks. 4. Your true standard of living is dictated by how inflation interacts with your wages. And 5. Central banks intervene using monetary policy to try and manage it all.
Which brings us right back to where we started. Understanding inflation isn't just some boring academic exercise. It actually helps you decode what's happening to your prices, your paycheck, your savings, and the world around you. So I'll leave you with this final thought to ponder. With a $100 bill in your pocket today, based on your specific lifestyle, what will your personal inflation experience look like tomorrow? Thanks so much for joining me for this explainer. If you want to keep mastering the economy through focused breakdowns just like this one, make sure to subscribe. See you next time.